to Mission Well's Market Perspectives for the third quarter of 2014. My name is Matthew Adams, and as always, I'm joined by Kieran Osborne. We are here to discuss some key themes and give some commentary around not only the first half of 2014, but the second half. Specifically, we've been receiving questions about the economy. We've seen some mixed data, seen some prints down and prints up in GDP. Our clients are curious what sort of message this is, sort of story this is telling. We're getting questions about the bond market, as we have been for the last year and a half to 2 years, and looking for additional yield. So we've got some points there. And then finally, we want to summarize the results of 2014 so far. We've seen some very good, consistent and positive results. Looking forward into the second half of 2014, we'll have some data to share as well. So I thought we'd kick it off by having Kieran give us a brief update on the economy and some points of interest.
Great, thanks, Matt. Yeah, we did witness a pretty large fall-off in GDP in the first quarter of 2014. GDP fell 2.9%, which, to give some context around that number, was the weakest post-World War II outside of a recessionary environment. But that said, we do believe it was largely driven by weather-related issues. And we are seeing some encouraging signs, particularly in cyclical sectors. As these charts show, auto sales, housing starts, and retail capital goods orders have all rebounded strongly, which has all culminated in a very positive second quarter GDP print of plus 4%. Turning to the unemployment rate, we're seeing significant improvement in the unemployment rate, which is now down to quite close to its 50-year historic average. At the same time, though, the labour force participation rate has fallen off quite somewhat, which indicates that there are a lot of long-term unemployed who are finding it difficult to find work. But the fall-off in the participation rate cannot explain the entire fall-off in the unemployment rate. Indeed, the main driver of the drop in the unemployment rate has been job creation, a very positive sign. Now, let's take a look at the long-term drivers of economic growth, those being capital, labour, and productivity. As the top left-hand chart depicts, capital stock has increased somewhat, but still remains at relatively low levels of growth, around 1.5%. Productivity and labour force growth are both fairly low. In fact, in the case of labour force, in the case of the labour force, in 2013, actually witnessed a contraction. All of which may indicate that the long-term outlook for the US growth is somewhat benign, and does help support our view that taking a global approach to investing may allow investors to access markets where growth dynamics are a little bit more favourable. Another aspect to the somewhat benign long-term growth outlook in the United States is that it may weigh on interest rates going forward. With that, I'll turn it back to Matt.
Thanks, Kieran. You know, that longer-term growth rate and low interest rates are indeed part of the puzzle. The second big piece, we believe, is central bank behavior. And specifically, we'll take a look at the Federal Reserve. So with that lower long-term growth, we're going to see some lower long-term interest rates. But the Federal Reserve is certainly involved. They've maintained their zero interest rate policy, still in place. We can take a look at this chart here in the upper right-hand quadrant where we measure yield curve steepness. And this just essentially makes the point that the short-term Fed funds rate and the 10-year Treasury are intertwined. One really does not get too far away from the other. The second point we wanted to make is that, you know, beyond the 10-year, even longer-term interest rates have been affected by this. We saw a dramatic decrease in the long end of the curve in the first half of the year, leading to some very unexpected yet positive results from long-term bonds, long-term municipal bonds, which was great. The final point that we wanted to make is that, you know, the Federal Reserve really has communicated this pretty well. They are likely to end their purchase of treasuries and mortgage-backed securities in late October. They really would be the first central bank to make this move and to not necessarily stop the easy monetary policy, but they're definitely moving into a place where they're going to slow, if not plateau, the pace of monetary policy. So looking abroad, we look at the Bank of Japan and we also look at the European Central Bank. The Bank of Japan has pursued the most aggressive monetary policies really in the world and for quite some time. Last year we talked about Abenomics, which was a policy to just massively increase the balance sheet of the Bank of Japan. And we've also talked a little bit about the European Central Bank. And although this chart depicts a drop in the pace of monetary easing by the European Central Bank, the ECB really has three main tools, and they're, we believe, just getting ramped up with them. The first one is that they've lowered the deposit rate it pays its banks to a negative 0.1%. This is the first time in history this has happened, and that eclipses the zero interest rate policy here in the United States. So this is really a very aggressive move. Secondly, they have a couple of programs in place, the targeted long-term refinancing operations. This supports bank lending. And they also have outright monetary transactions. This allows the ECB to purchase European sovereign debt. This is very similar to the quantitative easing that we've seen in the United States. So, you know, we really ask the question, why is this all important? Well, historically, there's been a very tight correlation between balance sheet expansion, in this case, the blue listed here for the Federal Reserve, and the equity markets, which is in the red here. This is the S&P 500. And since 2009 through 2014, we've seen extraordinarily tight correlations between balance sheet expansion and the equity markets. Almost perfect correlation. We show a 0.97 here. So, you know, as we look across the globe and we think of the United States perhaps slowing its pace of monetary policy, and then we also look abroad and see other markets like Europe and Japan increasing their monetary policy and making it even easier, we're encouraged to look abroad in terms of opportunities. Moving ahead, we take a look at results in the first half of 2014. Year to date, we saw some very strong returns from some interest rate sensitive asset classes like real estate, up 16%. But really very strong and consistent returns with mid to high single-digit returns out of a great many asset classes, and with an asset allocation model producing 5% plus returns. We see that as a favorable result given its lower risk profile, not only year to date and in 2000 and in years past, but certainly over the last 10 years. We see very positive results from this asset allocation, lower risk strategy when you compare them to broad indicators like the S&P. So, you know, we've observed some historical results here. We've seen a good start to the first half of 2014 here. So I'm going to turn it over to Kieran to take a look at current conditions and see if they might be indicative of what the future is to hold.
Thanks, Matt. So within developed equity markets, where do valuations currently stand? Well, particularly outside of the United States, developed equity markets are trading pretty close to historic averages, which indicates a lot of the valuations do suggest fair value. But what is very interesting is that if we take a look at dividend yields around the world, in many instances, equity markets are providing pretty compelling opportunities. If I look particularly in, say, the UK, a dividend yield of 3.6%, and in Australia, a dividend yield of 4.6%. Versus the bond market, these yields are fairly compelling and suggest potential upside going forward. Talking specifically about the US equity market, the outlook here is for earnings growth rates around 14% over the next 12 months. That's consensus estimates. The current forward PE is just under 16 times, and we believe a PE between 15 and 16 and a growth rate around 10% to be reasonable assumptions. Based on these numbers, the estimates for the S&P 500 return are around the mid to high single digits. Now, while this is somewhat lower than recent years, relative to the outlook for the bond market, we do think that US stocks do appear to offer opportunities. What about emerging markets? In emerging markets, we believe there is more compelling value to be had. Emerging markets are particularly dependent upon global liquidity, and while we see the Fed tapering somewhat, the ECB and the Bank of Japan continue to ramp up their easing monetary policies. All of these easy policies are aimed at stimulating developed market growth, which in turn should have a positive impact on emerging market exports and emerging market economic growth, and therefore their stock markets. And finally, turning to the bond market, expectations are for rising rates globally. Central banks around the world have been following very similar paths. We talked about the Fed, the ECB, and the Bank of Japan all following very similar easy monetary policies. And what's happened because of that is that yields have traded within much higher correlations to one another. That said, we do expect the United States to end its easy monetary policy ahead of other developed nations like Europe and Japan, largely driven by the more favorable economic growth rates we're witnessing here in the States. And therefore, it's likely that yields in the US will rise ahead of those internationally, all of which is likely to weigh somewhat on bond market returns going forward.
Okay, great. Thanks, Jaron. Really appreciate it. So really just to summarize the actions being taken, we really continue to prefer a greater tilt towards global equities. We talked about those relative valuations and strong profits and strong growth that we're seeing. Point number two, we've been talking about our fixed income alternatives portfolios for some time. We've recently added 2 new unconstrained bond fund managers. The investment committee went through an exhaustive process there, and the intention is for these 2 fixed income managers to better navigate a rising rate environment, which we see over the years to come. We're continuously looking for refinements, specifically where we're looking at our large cap equity strategies and developing an ability for socially responsible investing. We've also added a mutual fund that we believe has enhanced return potential. And then finally, due diligence is always an item here. We have a number of projects underway looking at our high-yield municipal bond allocation, our high-yield corporate bonds, large cap, as we discussed, and certainly on the hunt for unconstrained bond fund managers. So we have a busy second half of the year ahead of us. We really appreciate your time and attention to this presentation. As always, please feel free to contact your client advisor should you have any questions, and we're always happy to help. Thank you so much.